Welcome back, you legends. I'm Dr. Cal. This is going to be a quick update video that I needed to make because I noticed something going on very peculiar with the VIX. Now, this is the chart, the daily chart for the VIX. And if you notice, guys, we did gap down all the way to this support line that I pointed out just a few days ago. We could undercut it slightly, but I think the VIX is going to hold right around these levels. And very interestingly, guys, if I add the S&P on here, guys, I want to point out something fascinating that I noticed. Now, look at the VIX. It rallied all the way up to the red resistance line from support. It rallied, got rejected multiple times, came back down all the way to support. And if I take a look at the 2-hour chart, let's take a look at the 2-hour. Very interesting look on the 2-hour. If you notice, we have now this wedge looking structure, bottoming wedge or a bullish descending wedge, and we do have a bullish divergence between the price action and the momentum, especially now that we've tagged the support line. I want to show you the last time we were in something that looked very similar to this, and it was back in February. Look at this, guys. This was the double top. In February, we made a high February the 2nd. We made a double top February the 9th. And if you look here, guys, the VIX had rallied all the way up to the resistance line, rejected, came all the way back down, made a double bottom with a lower high, a lower low on the second low. Here it is. This is the first low. The second low undercut it. Then we had a breakout of volatility the next day, and that triggered the next sell-off in the S&P 500. So what I'm looking at now, guys, is for today, for the market to really hold these levels, for the VIX to stay somewhat low today, maybe rise a little bit, maybe do something that looks like this, come back down, come back up, then come back down, form a doji. And then we see a breakout tomorrow. If that happens, I think we'll get a double top on the S&P 500, where we made a high here on March the 22nd. We now rally again, make a double top here, get rejected at the 50-day moving average, this green moving average, and this prior support line, now a resistance line. Look at how so many trend lines here are converging, guys. We have the resistance line from the top of February the 2nd. Then we have the support line, the bear market counter trend rally. Yes, this entire move has been a counter trend rally. And we have the support line. We broke it. We have retested it once. We will likely retest it again. And I'm hoping to see something that looks a little bit like this, but close high. I want to see the market close either at the 50-day or even above it, right? Really flirt with this prior support line, now a resistance line. I want to see the VIX get crushed here, and then I want to see a big reversal the next day. That would likely complete a double top, something that looks like this, a double top. We come back down, retest the lows from March, make that double bottom, finally a decent double bottom. Then we will likely, guys, just chop around for quite a while and respond to earnings very, very violently throughout the earnings season that's coming up. So that's the VIX. The VIX is telling me that we are potentially making now a double bottom on the VIX, a double top on the S&P 500. And the second chart that I want to talk about is HYG. The smart money is up top, the dumb money is down below. And if you notice, guys, let's take a look at the smart money. Here is the close, that top that I talked about. We actually nailed the stop. I called the stop a day before it happened. And what happened here, guys, is that market actually did top on March the 22nd, then reversed. And what happened after that is that the S&P closed higher the next day, closed higher the day after that, and closed higher the day after that. If I take a look only at the closing prices, so if I convert this to a line, here it is. We top March the 22nd, their intraday top. Then if you notice, HYG lower close, lower close, lower close, lower close, while the S&P has been rallying slightly. The line makes it easier to spot this divergence. S&P rallying, HYG significantly declining. So the smart money has been dumping the risky parts of the bond market here. We are likely now, guys, completing that divergence and the double top probably today, ahead again of that PCE data point that's coming out Friday. So probably a double top today. We'll get potentially some sell-offs tomorrow on the initial jobless claims, completing that double top, then more selling on PCE potentially as the VIX breaks out. Now, how am I going to categorize the breakout in the VIX? Well, I'm going to look at one key thing, and that's a crossover on the 2-hour chart. I think if we get a crossover on the 2-hour chart, that will confirm a double bottom or a bottoming descending wedge, bullish descending wedge, whatever you want to call it, and we'll probably get a breakout all the way back up to these prior highs at 24 to 25 on the VIX. Let's take a look at TLT. Again, another divergence here on TLT. The market has been rallying and the bond market has been coming down. Now, the prior divergence actually did mark the top in the S&P, and we're now getting this critical point where the bond market is significantly diverging from the S&P 500. The PPO is even about to cross down on TLT. I think if we do get that, we'll see a lot of selling, especially in the triple Qs. This chart looks quite vulnerable in my opinion. We do have this rollover look. If you notice, market rallying, moving up slightly, then coming back down. I think we need to see one more push to the upside, complete a double top just like the S&P, and then break down all the way to tag this prior resistance line, now likely a support line. That would be a pretty major sell-off. If we did that, that would be, let's see, a 6% sell-off. But that's right now what I'm thinking. I'm thinking market rallies today, reverses tomorrow, the VIX breaks out, we get a sell-off, and we get more selling on the initial jobless claims tomorrow and the PCE Friday. Let's take a look at the Dow Jones. The Dow Jones looks now a little bit stronger. It is struggling again at that prior level of resistance. Not a lot going on with the Dow Jones here, guys. I'm not really in favor of shorting or going long the Dow, the S&P, or the NASDAQ, quite honestly, quite yet. But if we do get that VIX breakout, I will be going short the S&P most likely. Let's take a look at gold. Again, just moping around here, moving sideways. Not a lot to see. Momentum is up, but it is slowing down. Not a lot of information in this chart quite yet. Let's take a look at the DXY. The dollar still holding this level. Momentum is slowing down. We might see a breakout in the VIX, pushing the dollar back up to the 20-day moving average. Potentially find resistance at the 50 and the 20. This pocket here between, let's see, 103.5 and 103.85. Let's take a look at the 10-year yield, about to cross, but it is looking very vulnerable here. Very likely what we'll see is a move back up, especially on PCE, and very likely either find resistance at the 20-day and the 50-day at 3.68%, or move slightly higher and find resistance at these prior wicks here at 3.9%. Either is possible, but I think we make a lower high and we continue down from that point on. Let's take a look at Apple. It is still trading within this bullish ascending channel. PPO is starting to curl down. Momentum is dying. Really eerie looking charts all over the S&P 500, and that's because we're entering that time period where the market is trying to read whether the bear market is over, which I don't think it is at all, or whether we're going to get that massive crash in the back half of the year. And I'm going to discuss that in the upcoming video. I'm going to make a video that talks about this bear market, how similar it is to the 60s and 70s bear markets. Now let's take a look at AMD. Very vulnerable look. If you remember, guys, I did point out that on the monthly chart, this looks like a almost picture perfect head and shoulders top. So far, it has failed to cross this red line. We had a whole bunch of rejections here. Very really vulnerable look. A lot of indecision candles, rejection once, twice, and then decisive break to the downside. We are now gapping up on the day, but if you notice, even with the gap up, even with the rally in the S&P and the NASDAQ pre-market, we just rallied to the middle of this red candle. In my opinion, AMD looks extremely vulnerable. Tesla looks really messy, and that's because it is still really trading within this pocket. It's been coiling now for quite a while. Coil, coil, coil. I think it's ready to break down, in my opinion, and they break down all the way to fill this gap at 144. Why do I say that? Well, if I open a chart of XLY divided by XLP, consumer discretionary divided by consumer staples, what do you see here, guys? Very vulnerable look. A breakout above the 50, above the 200. Rejection at the top of the Bollinger Band. This prior area of support now is resistance. A lower high the second time. Breakdown all the way below the 20-day moving average, below the 200-day, below the 50-day. Break all of them, come back, retest the 200-day, and reject decisively with momentum slowing down. So I think this is going to be a major, major break. And just based on what I'm seeing from this chart, guys, I think XLY divided by XLP will go all the way down to 1.8. This prior area of support should hold, and if it breaks, we will see even lower lows all the way back to these lows in December. But so far, I think more likely something that looks like this, right? A inverse head and shoulders that goes all the way down here. I think that will allow Tesla to fill that gap at 145. Let's take a look at SMH. Again, it held this prior area of resistance, now a support trend line, but again, looks quite vulnerable. Look at this double top formation, lower high on the PPO, significantly lower high. So this is a huge, huge bearish divergence. I think the SMH will continue to form these divergences. Very likely something that looks like this: inverse head and shoulders, break this prior support line, go all the way back down to this level, held that support here, held that support, will likely revisit it again at 195 to 200. Let's take a look at the put to call ratio. Very tricky here. We did get a close on the PPO, a double top here on the PPO, and a close below, and that would be a technical buy signal. But we did have one false buy signal here. The market did nothing, and I'm now looking at this period and comparing it really to this period back here in early February into 2022. Very confusing time, a lot of choppiness. We did not get really a solid buy signal until March 9th on the PC. If I take a look at the CPC, same thing here, guys. A lot of choppiness. We did get a buy signal here, an early buy signal, but a major buy signal did not come until March, let's see, 17th, this green bar here. We're getting a lot of zigzags here, cross down, cross up, cross down. Not very useful, and that's why I wanted to take a look at this chart. This chart really quantifies risk appetite in the bond market, and the bond market tends to be more precise, more accurate, more truth-telling, to be honest. It doesn't really lie. Usually the S&P 500, the stock market, usually really gives out these false breakouts, these mixed signals, but not so much in the bond market. And that's why I developed this new indicator, and now I'm waiting for a cross down from green to red on this indicator to potentially signal a buy signal. If you notice, guys, the last few times this switched from green to red, we had pretty decent buy entries, including this low in May. We rallied after that. We had a bit of a pullback, then we rallied, a bit of a pullback, then we rallied. Here we rallied without a pullback. If I take a look at the summation index, let's take a look at the summation index, almost crossing over here. And again, this crossover usually comes after the market has decided to trend up, right? We had a crossover here, October 18th, market rallied. Another crossover, January the 5th, the market rallied. Another one right here, July the 22nd, the market rallied. But we did have a period of chop right here, cross up, cross down, cross up, cross down. Really messy price action. And I think the current conditions in the market would favor more of this kind of choppy trading chop box. Mainly because I don't think the market retraced low enough for bulls to get excited. I don't think it rallied enough for bears to get excited. It's in the middle. Look at this equilibrium. If I really divide this area by 2 in the S&P, we're smack in the middle. So really choppy trading. And if I did the same thing here, guys, look at this. If I put in a chop box here and I put in the same thing and I divide it by 2, again, we're smack in the middle, and so that would favor more of choppy trading in my opinion. Let's take a look at the economic calendar. Tomorrow, initial jobless claims. If this comes higher than expected, the market will like it and will rally. If it comes lower than expected, that would indicate more inflation, core inflation. Then we have PCE Friday. Two key events, I think, tomorrow and Friday. And with the market now gapping up and rallying ahead of that event, I think it favors more breakdowns to the downside, especially again if the VIX rallies to the upside and breaks out tomorrow. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye bye.
Oh, wow.